Continuing on with our Jobs Day conversation, our next guest says soft landing expectations have been boosted with this morning's report, but the clock may be still ticking on a recession. For more, let's bring in Seema Shah, Principal Asset Management Chief Global Strategist. Seema, Happy New Year. It's great to see you.
Happy New Year.
What does this report tell us about whether indeed a soft landing is more possible?
Well, look, I mean, first of it, it's clearly a very positive report. You know, there were concerns that average earnings growth, average earnings would continue to stay pretty strong. So that is clearly a positive. But I think you have to look at actually probably the most important part of the report and say, look, the unemployment rate is your best picture of that demand and supply balance of the labor market. And the fact that it's come back down to 3.5% historic low tells you that the labor market is still extremely tight. So I have to be very skeptical that with that state of the labor market, you can continue to see wage pressures easing. So it's a positive, but I certainly don't think it changes the game, certainly for the Fed. And it doesn't really mean much with regards to changing the outlook for the economic hard landing that we're anticipating.
All right. So an economic hard landing, I mean, we heard shallow recession earlier. Economic hard landing, would that mean you see a mild recession or something that is more protracted than that?
Yeah, it's a really important question to ask, actually, because we get this a lot from our clients. So I think, at least from our perspective, when we talked about a soft landing, that to us is no recession. A hard landing is recession. Now, we are expecting the recession to be somewhat shallow, to last 3 quarters, which is the average length of the US recession historically. So this is something which is not anything close to the global financial crisis, but it is still a recession, absolutely.
Seema, should investors be buying dips on the markets going forward just based off of this jobs report?
No, I think that would be a foolhardy thing to do. You know, we have to look at beyond just the next month, the next couple of weeks, and just take a look back and say, look, the Fed has raised rates by 425 basis points in less than 12 months. They've already indicated very clearly that they're going to take rates even higher. And not only that, but they're going to keep rates high. And the economy hasn't yet really shown clear signs. So that pain for the economic perspective is still to come in 2023. So as you get that economic growth slowdown coming through, that will inevitably have an impact on earnings growth. So from an equity market perspective, there may well be days like this where the market does well. But taking a step back and look at the big picture and saying, well, look at what the economy has been subjected to over the last year or so with rate hikes. And unfortunately, that does mean that there is a decline in earnings, which is on the way.
And Seema, looking at some of your outlook for 2023 overall, it seems like one of the big takeaways is that outside of the U.S., equities might be more attractive than inside of the U.S. Let's sort of take that point by point and talk about China first, because China is certainly part of that global outlook.
Yeah, you know, with the China reopening, what we should see now, look, at the moment it's pretty chaotic, and you could probably see that activity stays somewhat low in the near future. But inevitably, at the end of this, just like we saw for the US, for the UK, for Europe, that reopening should trigger a fairly meaningful bounce in activity. Now, that's in the short term. But when you start to look out towards the end of the year, we are somewhat concerned that some of the previous concerns about China starts to return. So what are they going to do with their regulations? They're not really letting go of their common prosperity goals. So we are not entirely convinced that this is going to be a sustained rebound, but certainly in the short term, at least if we're looking at over the next 6 to 9 months, this could certainly be a good news story. And when you look at China's equity valuations, which are still flagging pretty cheap, that could be a good opportunity for short-term investors.
How would you evaluate companies, though, here in the U.S. that have the most exposure to China, either on revenue side or on the production side?
It's a great question. You know, one of the things that we've been worried about, is particularly when you think about large cap companies, is their exposure to external forces, to outside countries, Europe, Asia, which have struggled not only with supply chains, but just generally with their recovery. If China's growth outlook can really pick up to a point where it actually has a very positive impact on countries, on their main trading partners across Europe, across Asia and emerging markets, then that would mean better news for large cap. But at this stage, I think the jury is still out, at least in the short term, for large cap companies. So we are not yet increasing our exposure to those. And instead, we still prefer the mid-cap companies within the US, which still have a slightly greater domestic exposure.
Seema Shah, Principal Asset Management Chief Global Strategist. Always good to see you. Have a great weekend.
Thank you.